Imagine getting paid for letting someone use your extra room, but with a lock so that they don't mess up your house. That's a credit spread. Let me show you how to earn premium without risking much capital. Hi, I am Pranav VK and your options trading guide here at Stockshaala by Kotak Securities. In the previous video, we learned all about debit spreads and how we can use it in various market conditions. In this video, we're going to cover all about credit spreads and how to make the best use of it. In fact, net credit spreads are my favorite because they are equivalent to option selling, and you know that probability of profit in option selling is higher than 66% theoretically. A net credit spread involves selling an option contract and as well simultaneously buying an option contract, whereas you'll have net premium inflow and a cap on your risk as well. So a net credit spread is almost the exact opposite of a net debit spread. In this case, you're going to sell an at-the-money call option or a put option and buy out-of-the-money call option or a put option. But the catch here is that the option which you sell is going to have a higher premium and the option that you're going to buy is going to have a lower premium, which means you're going to have net positive premium coming in for entering into this specific spread. Since a net credit spread is equivalent to an option selling but with limited risk, this is going to work best in sideways market as well as moderately directional markets. There are two types of net credit spreads. One is bull put spread as well as the bear call spread. So we are going to explore each one of them one by one so that you understand it better. So let's learn how to get into a bull put spread. So initially you're going to sell an at the money put option and simultaneously we are also going to buy out of the money put option. Let's head to the whiteboard for a clear example. Here in this case, I have first done selling of at the money put option, that is 19,400 put option at rupees 60 premium, which means we have received rupees 60 in this case. And simultaneously, I'm also buying an out of the money put option, that is 19,200 at a premium of rupees 30, which means I'm paying rupees 30 in this case. So overall, I am receiving 60 rupees premium minus I am paying rupees 30 premium. That is going to become my net credit, that is rupees 30. Now let's also calculate the maximum loss. It is nothing but the strike difference, which is 19,400 minus 19,200, which is going to be 200, minus rupees 30, which is the net credit. So the maximum loss is going to be rupees 170. And my maximum profit is nothing but the net credit, that is rupees 30. Now let's calculate the break-even point for this specific spread. So it is nothing but the higher strike, which is 19,400 minus the net credit, that is rupees 30. So in this case, the break-even point is going to be 19,370. One of the clear differences that you can see between a net credit spread and a debit spread is in the maximum loss as well as the maximum profit. In this case, you can see that the maximum profit is just rupees 30, whereas the maximum loss is rupees 170. Whereas in net debit spread, you can clearly see the difference that the maximum profit was much larger, whereas the maximum loss was very limited. But because of this reason, majority of the retail traders go and end up doing net debit spreads where they don't look at the probability of profit. So hence I urge you to look at probability of profit whenever you're entering into a spread strategy as well. So now let's look at the payoff diagram for this specific spread. So here you can see that we have the payoff diagram, the profits above zero, below zero is the losses, and on the x-axis we have the possible strikes, right? And here we can see that the maximum profit is very small, that is to the extent of just rupees 30, whereas the maximum loss is much larger and it is nothing but the strike difference minus the net credit. And finally, we also have the break-even point, that is here. Now let's head to the next spread, that is bear call spread. Bear call spread is where exactly you're going to sell at the money of a call option and simultaneously buy out of the money of the call option. So let's look at the whiteboard and understand a real example. Here I've taken an example of selling an at the money call option, that is 19,600 call option at rupees 50, which means I'm receiving a premium of rupees 50, and I'm buying a out of the money call option that is 19,800 at rupees 20, which means I am paying rupees 20. So the net credit is nothing but rupees 50 minus 20, that is rupees 30, which is also my maximum profit potential. Now to calculate my maximum loss, I have to identify the strike difference, which is 19,800 minus 19,600, which is nothing but 200, minus my net credit, that is rupees 30. So my maximum loss is again rupees 170. Here also clearly you can see the difference that the maximum profit is very small, whereas the maximum loss is much larger. And finally, let's also calculate the break-even point. So in this case, for a bear call spread, it is the lower strike plus the net credit, which means it is 19,600 plus 30. So that is going to be 19,630, which is going to be my break-even point. So let's head to the whiteboard to look at the option payoff diagram of a bear call spread. So coming back to the whiteboard here, you can see that above 0 is again profit, below 0 is losses, and on the x-axis is the possible strikes. And the maximum profit, as we discussed already, is nothing but the premium received minus the premium that we have paid, that is rupees 50 minus rupees 20, that is rupees 30. But whereas the maximum loss is the strike difference minus the net credit, which is 200 minus 30, that is rupees 170. And the break-even point is nothing but the lower strike plus the net credit, that is 19,600 plus rupees 30. So this break-even point is going to be 19,630. So the clear difference that I mentioned is the maximum profit is smaller, but the maximum loss is bigger. But don't get biased by this, because probability of profit is more important than higher profits. So when exactly can you use each of these spreads? As the name itself suggests, a bull put spread is something that you can use when you expect the market to go higher or stay flat. Whereas you can go for a bear call spread when you're expecting the market to go lower or stay flat. Net credit spreads are my favorites because they are theta positive, which means with time you make more money if the market is sideways or in your direction. Whereas net debit spreads are theta negative, which means you're always against time. And when it comes to the delta Greek, a bull put spread has a positive delta, whereas a bear call spread has a negative delta. Here are a few risk management tips while trading net credit spreads. Number one is that you have to make sure you're having the right kind of stop losses, because as you know already that the losses are larger and the profit is smaller. Avoid setting up net credit spreads near major events, because that can lead to a lot of havoc in the premiums. Use OI zones to place your spreads away from key resistance and support levels so that your premiums will expire worthless and you're going to get the entire premium of the spread. And finally, always make sure you're choosing the strikes which has really good liquidity. For example, psychological levels like 25,000, 24,500 or even 24,000. Credit spreads are favorites of smart traders because they get to make money by just waiting and managing the risk well. So let's recap what we have learned so far. We understood that a net credit spread is created by selling an at-the-money call or put option and simultaneously buying an out-of-the-money call or put option. In this case, you're receiving a higher premium and you're paying a lower premium, because of which you're getting net credit. We also learned that net credit spreads are basically equivalent to naked option selling, but with limited risk and limited profit. Most importantly, in a net credit spread, theta works for you, whereas in a net debit spread, theta is against you. And finally, since the maximum loss is higher than the maximum profit in a net credit spread, it's important for you to manage the risk wisely. In the upcoming video, we're going to do something fun. We're going to compare all the 4 strategies and see what is the best one to use for your strategy toolkit. You're watching Stockshaala by Kotak Securities. Make sure to subscribe and share it with your friends. I am Pranav VK and I'm going to see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.